Nobody tells you this when you first start, but real wealth isn't a flashy number on a digital screen. It is the quiet silence in your head when you lay down at night, right now. Millions of ambitious 30-year-olds are trapped in an exhausting cycle of financial urgency, chasing fast yields, checking portfolios 10 times a day, and living in constant anxiety. While a small, calm group of retired investors moves through the world with absolute peace, they aren't smarter than you, they don't have access to secret algorithms, and they certainly aren't taking extreme risks. So, what do these seasoned veterans know that younger investors spend decades failing to see? If you stay with me over the next few minutes, you are going to discover 3 deeply hidden behavioral strategies that completely transform how wealth is built, including a real-life corporate breakdown that reveals why fast growth is often a silent trap. And if you are serious about protecting your future from invisible financial mistakes, make sure you hit that subscribe button right now. Because what we are about to unlock could save you 20 years of unnecessary stress. Let us begin with a micro story that illustrates the exact moment everything changes. Picture a rainy Tuesday evening in 1998. Inside a dimly lit corner office, a 32-year-old manager named David was hyperventilating. His screen was flashing red, and he had just lost 40% of his trading gains in less than 3 hours, in total desperation. David walked down the hall to the office of Arthur, a 70-year-old veteran advisor who was calmly sipping tea and reading a book. David slammed his hands on the desk and yelled, "Arthur, how are you just sitting there? The entire market is collapsing, our future is being wiped out." Arthur didn't even flinch. He set his tea down very slowly, looked over his glasses, and asked a single, quiet question. "David, did the companies you own suddenly stop selling products today, or did a bunch of frightened people just decide to trade pieces of paper for cheaper prices?" David froze. Arthur continued, "You are panicking because you think money is about speed and status. I am calm because I know money is simply energy stored for time. You are playing for today's headlines. I am playing for the rest of my life." This brings us directly to our first major strategy reveal, the pressure valve principle. When you are 30, your relationship with capital is driven by social comparison. You feel an invisible clock ticking in your head, telling you that you are falling behind your peers. This emotional pressure forces you into aggressive asset choices. You search for high-beta stocks, speculative tokens, and leveraged opportunities, all because you want to compress 20 years of compounding into 24 months. But retired investors understand a brutal economic law: chasing speed always destroys safety margins. To see how this plays out in the real world, let us examine a fascinating case study between 2 competing retail chains during the mid-2000s. Company A was run by an aggressive young executive team. Their strategy was hyper-expansion. They took on massive amounts of short-term debt to open 200 new locations in less than 3 years. On paper, their revenue was skyrocketing. The financial media called them geniuses, and young retail traders poured their savings into the stock. Company B, managed by a 65-year-old founder who had survived 3 major recessions, took the exact opposite path. He refused to borrow money for fast expansion. Instead, he focused on strengthening existing operations, building a massive cash cushion, and growing only when internal profits allowed it. Young market analysts publicly criticized him, calling his approach lazy, boring, and hopelessly outdated. Then came the credit freeze of 2008, when the economy contracted. Consumer spending dropped almost overnight. Company A, burdened by massive monthly debt obligations and zero cash reserves, collapsed under its own weight. They were forced into liquidation, and their investors lost every single dollar. And what happened to Company B? Because they had zero debt pressure and a massive cash balance, they didn't just survive the crash. They bought out Company A's best real estate locations for pennies on the dollar, doubling their long-term enterprise value in less than 18 months. The young executives built a structure for clear weather. The retired founder built a fortress for the storm. Now, stop and ask yourself an honest question. Is your current portfolio built for clear weather, or is it built to survive a storm? This brings us to our second hidden mechanism: the unseen tax on urgency. Every single time a young investor feels the itch to tweak, trade, reallocate, or jump into a new trend, they are paying an invisible emotional tax. It isn't just about transaction fees or capital gains taxes, though those silently bleed your returns over time. The real tax is the mental space you sacrifice when you check your accounts multiple times a day. You subject your brain to continuous microshocks of dopamine and cortisol. You become emotionally dependent on market ticks, which guarantees that at the absolute worst possible moment, when market fear reaches a peak, you will make a panic decision to stop the psychological pain. Retired investors operate on a completely different psychological wavelength. They design their portfolios with intentionally high friction. Consider the story of an old institutional fund manager who used a physical lockbox for his long-term asset allocation rules. Whenever he felt a powerful urge to alter his core holdings during a market panic, he forced himself to write down his rationale on paper, lock it in a safe, and wait 72 hours before opening it. 99% of the time, by the time those 3 days had passed, the emotional wave had cleared. Logic had returned, and he left his portfolio completely untouched. He didn't rely on willpower, he relied on built-in delays. This leads directly into our final and most powerful open loop, the ultimate utility of wealth. Why are you actually trying to grow your money? If you ask a 30-year-old, they will usually describe things: nicer cars, bigger homes, exotic travel, or a higher status in the eyes of their social group. If you ask a retired investor, they will give you a completely different answer. They will tell you that the highest dividend money pays is the ability to walk into any room, at any time, and say no. It is the ability to wake up on a Tuesday morning and decide entirely how your next 8 hours will be spent. It is the complete absence of anxiety when unexpected bad news arrives. Younger investors buy assets to impress people they don't even like, while retired investors hoard quiet control over their own schedules. Imagine standing at the end of your life, looking back over 40 years of financial choices. You won't remember the daily market fluctuations, you won't care about the temporary dips, and you certainly won't care about beating an arbitrary benchmark in a single quarter. You will only care about whether your money gave you the freedom to live life on your own terms. The choice facing you today is remarkably simple. You can continue running the frantic race, chasing speed, reacting to noise, and stressing over daily movements. Or you can adopt the quiet wisdom of those who have already crossed the finish line. Slow down your horizon. Eliminate debt pressure, build deep safety margins, and let the relentless power of time do the heavy lifting for you. Because in the grand game of wealth creation, speed is an illusion, but patience is absolute power.